Hello and welcome to Analyzing Finance with Nick. In this video, I'm going to be talking about my follow-up to my commentary on Jake Tran's video of 1971, because I got a lot of emails and questions and comments about why didn't you mention the fact that he stated at the end of his video that 80% of all dollars ever in the history of the United States were created in the last year and a half since the Fed really kicked its gears up for the pandemic. Well, I'm going to address that now, and the answer is probably going to surprise you. The main premise here that I think is being mistaken by Jake and other hyperinflationists who look at the money supply is that they don't really understand what the money supply is actually counting. There are, depending on how liquid the assets are, there's M0 deposits, M1 deposits, and M0 and M1 are basically things like cash, like hard dollars, currency, coins, and checking accounts, and savings deposits. M2 includes money market funds or anything with 24-hour or less liquidity, and M3 includes cash that has a little bit less liquidity, up to a year. That's generally how it works when it comes to money supply accounting. And what the chart that's been going around is that the M1 has gone up 5x in the past year and a half. So for the exact numbers, it's according to the Fed, which is the St. Louis Fed's economic data. It's gone up from 4.77 trillion in April 2020 to, as of October 2021, a little less than 21 trillion. So you're thinking, hey, wait, it's gone up 17 trillion. It's more than 5x. What's going on here? Well, there was a change in the accounting of M1 last summer in May 2020 when they moved savings deposits from M2 to M1, and that's 10 trillion of that jump on its own. So really, M1 has only gone up from, if you exclude the saving deposit accounting change, it's gone up, it's only 7 trillion, which is still quite a bit of money. But again, M1 is really only the very tip of the iceberg in terms of the money supply. I really think a more accurate way to measure really how much the money supply has increased is by looking at the change in M2. And the change in M2 over that period is about 15 trillion up to about 21 trillion. And that's still a significant move. Like, that's, if you do, it's about a 40% increase, which is sizable, but it's not the same as implied for saying 80% of all dollars are ever created. That's more like a 400% increase in the money supply. So it's a lot more moderate increase in dollars than is what is being hyped. That's step one. It's a lot of it's just a change in the accounting and not factoring really the true extent of the global money supply of US dollars. The second point really to make is that how much of those funds are really going into circulation. I mean, while the money supply has gone up, that's not really what determines the price level on its own. I mean, and I'm somebody who has sympathy for Austrian economics, but I think this is one of the flaws of Austrian economics, is that they don't factor in the velocity of money appropriately. According to Fred, the velocity of M2 has dropped 21.8% since the fourth quarter of 2019, which is the last quarter of complete data. If you want to go further back, since the 2008 financial crisis, the grand total of the velocity of money has dropped by almost 50%. Why is this the case? I have a few theories on that, and I may want to dive into this in a future video if the viewers would like me to. But there are several reasons I think this is. One, increased income inequality. Most money is getting into fewer and fewer hands, and the wealthy are more likely to invest that money into stocks and bonds and other financial assets and not have it circulate in the economy. And also with the popularity of more illiquid assets such as venture capital and private equity recently due to a low interest rate environment, that makes the velocity even slower. So if you have a lot of money in investment and speculation, that's not being entered into the real economy, and thus it depresses velocity. The other thing is demographic factor. Population growth is slowing, and a lot of what caused the velocity to be high in the 70s and the 80s and the 90s was due to growing populations of baby boomers buying a bunch of stuff for the first time, whether it's college stuff when they're younger, professional clothing and cars and things in their yuppie stage, and then stuff for kids and their children. And as they have now reached their older years, they're not spending as much money. They don't need to buy all this stuff for the first time anymore because they've bought everything they've needed to, and they've already went through the raising a family phase. And so therefore their spending is going down and the velocity of money is thus going down. And then also I think just a general, at least in the United States, a culture that favors more speculation. And it's kind of the irony of this, and this is just a theory I've kind of come up with now, I don't have anything to back it up, but I think a lot of the speculation in things such as VC and for cryptocurrency and other stuff like that might actually be deflationary, because if that money was being put into more productive things or consumer items, then maybe it would show up in inflation. So those are my theories on why velocity has declined, but there may be other reasons for it too, and that is a big factor in why we haven't seen such a big spike in inflation. So if you take away the velocity decline out from the total increase in money supply, which we said is about 40%, this is 21.9%, so that leaves about 18% in actual net price level that should go up. And if you look at the inflation data, it's about 7%. A lot of people would question that and say it's much higher. Let's just say, for argument's sake, it's somewhere between 10 to 12%. So it's 11% is the actual inflation number. So in that event, it's really the money supply difference is only about 7% more than the inflation we've already experienced, which is material, but that doesn't really spell hyperinflation to me. What would cause this, I guess, increased cash really to cause inflationary problems would be if supply keeps going down or staying low due to shortages persisting, and I've talked about the whole labor thing in previous videos as a factor in that, and money supply continues to grow at the current pace, but now with the taper it may not be growing at the same pace anymore. The final point really to make about this is the liquidity being added affecting the supply side as well as the demand side? Again, I could probably do a video on this topic too, but the general idea is why you saw with the last round of QE, say from 2008 to 2015, you saw relatively muted inflation, but the inflation was really only in things that supply could not be boosted due to easier access to credit. Things such as natural resources and manufactured goods, the supply was able to catch up with the increase in liquidity because cheaper financing allowed factories to make things at lower prices and larger scale. It also financed a lot of shale drilling projects for oil and new farming equipment and technology to be developed and land to be cultivated in agriculture. and other physical goods in the economy got the benefit from cheaper financing to increase supply. The places where you couldn't do that, either due to government regulation or due to increased speculative investor demand in those same products due to lower liquidity, were housing and healthcare. And that is where the concentration of inflation was during the QE era, which I say is like 2009 to 2016, were in those two spaces. And if you're going to get another round of inflation, it probably should be a repeat of that, because the same thing, housing is difficult to increase the supply at a fast enough pace to catch up with increased investor demand triggered from other interest-bearing assets for being too low of an interest to generate the cash flow that income investors need, and so they go to rental properties. And then also demographic factors of millennials moving to buy houses. So the housing supply cannot keep up due to increased demand, and also due to a lot of government regulations in many metropolitan areas that prevent the building to cover the demand. So really, the only real inflation that is determined primarily by monetary policy is housing inflation, to a lesser extent healthcare inflation, and that is often due to government interventions that prevent the increase of supply. So that's my thoughts on this. I generally think the whole idea of 80% of money supply being created in the last year is a myth, and I think that a lot of inflation is not seen due to three main reasons. One, decline of velocity of money. Two, the total money supply growth is not as big as people have feared. And three, a lot of cheaper financing actually can be disinflationary by creating additional supply in industries that permit that to happen. If you like the content here, feel free to like and subscribe, and have a Merry Christmas and Happy New Year.